I'd like to thank everybody for joining me today. Today, I want to talk about retaining our key employees. This is we're in a market where it's a really tight market, especially for key talent. And as we think about, the market for key talent, it used to be, you only had to worry about, your employees being maybe poached in your region, in your local area. Now with everything, going to remote work and those types of availabilities, now your key employees could be poached by somebody clear across the country or across the world. So we have to look at how do we retain our key employees, and I want to talk about using split dollar. If you think about if you think about the employment market, we go out, we work hard to find the key people. We structure benefits to keep them, but are you doing enough to reward and retain those key employees? And as we find, a lot of employees just want something a little bit different, something better. And if it's just about giving them more money, well, somebody else can do that too. And so if you don't have the deepest pocket, you may lose your key employee to somebody else. So it's thinking outside the box to do something more. And think about this. Would you consider a meaningful benefit to your key employees that would also allow you to recover that cost later? So a lot of times we're thinking, well, if I give them the benefit, it's taxable to them and deductible to the company. And that's not a bad way to look at it. But as long as you're providing them a meaningful benefit that allows you to recover that cost later, may fit into your business model. So when we look at split dollar loan is what we're going to talk about. In this case, the employee is going to own a life insurance policy on their life. There again, the employee owns the policy. The employer is going to loan the premiums to the employee to pay those policy premiums with interest. So there again, loans are not taxable. So this is not going to be a taxable transaction to the employee, therefore not taxable to the employee, not deductible to the employer. It's actually going to be a loan on the books, which there again, I like in for a lot of employees or employers, they're going to transfer money on their balance sheet from a cash account to a loan receivable account. So their balance sheet really stays the same. It's just how we treat the employee. And finally, there's going to be a repayment of the loan secured by a collateral assignment. A collateral assignment is a lien against the policy. This is how, as the employer, you can protect yourself and make sure that loan gets repaid by the employee. So there again, finally, no income tax or deduction in this type of plan. So let's see how this is structured. So the employer is going to pay the premiums. They can pay it direct to the insurance company. Once the policy is paid and everything's in place, the company is going to issue that policy to the employee. There again, the employee is going to be the owner of the policy. The employee can name the beneficiary of the policy, so his family, whoever it is that he wants to name. From the employer's perspective, this will be treated as a loan, and this is a loan with interest. We have to have a minimum interest there, at least the minimum required by the IRS. It can be more, but can't be less. And finally, we're going to have a repayment of that loan. If the loan is not repaid, then it's going to be treated as a forgiveness of the loan. We can also add non-recourse provisions in there, so we can get creative with this loan if we want to. But there again, we can have a commercially reasonable loan here. So let's look at this as a case study. So let's say the employer wants to set up a split dollar loan plan for their key employee. They're going to pay premiums of $25,000 a year for 10 years. So when we look at this, what I always look at is we've got to look at both parties, and it's got to work for both parties. So that we're going to look at it from the employer's perspective. Then we're going to come back and look at it from the executive or key employee's perspective. From the employer's perspective, they're going to pay premium of $25,000 a year for 10 years. That's the commitment that the employer has made. Now, if I look at this, we always look at, well, what's the total out of pocket? What is that going to be? It's $25,000 per year for 10 years as long as the employee meets the terms of whatever their split dollar loan agreement is. Now, I said there was a collateral assignment or a lien against the policy. The lien first is going to be on the cash surrender value. So if you'll see this in year one, the employer's paid 25,000. There's a $5,552 cash surrender value. That's the maximum cash surrender value available. But as you see over time, by the time we hit year 10, our cash surrender value now equals 250,000 liened by the employer. There again, the lawyer or the employer at this point is completely whole if they need to collect the money from the employee's policy. So that lien is like having a mortgage on your house. The bank, always has control of you selling your home. They get paid back first before you can sell your home. Same thing happens here. From the employer's side, if the employee were to die during this program, the employer will get paid back the amount that they're out of pocket. So you see that starts at 25,000, grows all the way to 250,000. Anything above that will go to the employee's family. Now let's look at this from the employee side there, key employee. The net annual outlay. Remember, this is a performing loan. If we can set up the loan provisions, we can have it paid annually, we can have it paid on demand, we can have it paid, sometime in the future, but we have to track the interest being paid, or at least the amount that needs to be paid. So in this case, I'm just showing interest of $220 for year one, for 40 year two, works all the way up. In over a 10-year period, it's 12,100 of interest paid by the employee. Now, think about that. The employee's out of pocket now for 10 years is 12,100. What's the benefit to the employee? Well, if I look at this and spread this out over a 20-year period, now and I'm showing a repayment of this loan in year 15. We'll talk about that in a second. But the total out of pocket the employees paid is 20,900, and they have access to all of this cash value as soon as the cash value exceeds what they owe back to the company. So they have access to cash value. I also look at it as, from the family's point of view, there's life insurance paid to the family. There again, this is the amount above what's owed back to the employer. So the employer's made whole. The family gets, throughout the life of this, somewhere close to $1 million of tax-free death benefit. So 20,900 is the total paid out by the employee to cover his family for approximately $1 million of death benefit. I said that this is a loan that has to be repaid. We can put the repayment anytime we want into the future. And so this can be if the employee leaves the business, leaves employment, they have to repay it then. Or in this case, the employee, I'm just showing it's repaid in year 15. So 250,000 gets paid from the employee to the employer. They can take that out of the cash value of the policy. They can use other assets, whatever makes the most sense. The employer's paid off. The employee no longer has any responsibility back to the employer for this policy. So you start looking at this. Look at all of the benefit that the employee gets, income tax-free. So they get to access the cash value tax-free. The family gets the death benefit income tax-free. And all of that benefit only costs the employee $20,900 over the whole life of this insurance contract. So you look at that, would you pay approximately $21,000 to have access at age 54 to 95,000 of cash, $900,000 benefit to your family? You start looking at this and the benefits can be very, very attractive. What I like from a key employee retention standpoint, we've not only provided a tax-free benefit to our employees, we've made sure that our business or the employer is made whole. And we've also protected the employee's family from a premature death, or they have this policy to go into the future to help with their estate planning from the personal side. So as you start thinking, think outside the box, think about what your employers that you're working with, how they can retain their key employee talent. I appreciate everybody getting on. If you have questions, feel free to reach out and we'll talk again next week. Thank you.